For our COBT fans, it's Maynard, Mike, and Arjun. We're here with something that's spectacular. We get to talk the macro today, and I mean the macro in every sense of the word. We're delighted to have Dr. Alexis Crow join us. She's a partner at PwC, and she's also head of the Geopolitical Investing Practice. I think this is a theme, Dr. Crow, that we've seen going on, which is boardrooms, management teams, investors. So many people are looking to experts like yourself to try to navigate all these complex geopolitical considerations that are out there. But you're renowned in your field, and we are just so delighted to become acquainted, become friends, and to get to talk to you about all these issues. So welcome, Dr. Crow.
Thanks so much, Maynard. It's an honor and privilege to join you all.
Well, this is great. Well, Mike and Arjun, this is really so exciting today. We're going to get to talk about all these factors. This should be our first 3-hour show. Maybe we can go Joe Rogan on this today. But Mike, what would you tell us as a lead into the conversation today?
Yeah, Maynard, given that today is Halloween, and I would say there's a lot of spooky things.
You're the first person to mention Halloween. Good job.
Right, a lot of spooky things going on in this market right now. You know, I would point to tomorrow you're going to have basically FOMC meeting. Most people expect that the Fed is going to pause. If they don't, that will be a huge negative surprise, but that's what bond markets are thinking right now. From a commodity standpoint, crude oil is essentially lower today than it was on the October 7th, Israeli issue. And so, that's concerning. I just think, what's going on is fundamentally things, don't look strong. It looks like basically time spreads are weakening a little bit. So physically things look a little bit weaker, and so that's what's going on there. And I just think there's just this sanguine case of what's going on in the Middle East, that it's not going to spread. I just think that's a really, really, tough bet to basically take. So just be careful with that. From the standpoint, I think over the last couple days and weeks, we've had earnings from, most of the companies out there, refiners, major oil companies, E&Ps. We're going to continue to see that roll in. But what kind of struck me here is, really talking about some of these energy transition names, sticking with that spooky, theme that we talked about a little while ago. I mean, we're just seeing, like last week we had the UAW agreed with the auto companies, to avoid these labor strikes, and you're going to see costs go up 25 to 30%. That's going to mean higher vehicle prices. EVs right now are not selling through very well. You're seeing production schedules being pushed out, not from Tesla, but the other big three, and so that's a concern. You're seeing solar companies, mixed bag, but most solar companies are seeing weakness in Europe, because of rates, whatever the case may be, so that's a concern. You're seeing wind issues. Ørsted's going to report earnings tomorrow. They're probably going to take additional write-offs. BP had their earnings today. They took a write-off in the U.S. For their New York assets. And so, things are not progressing well there. The last thing we'd say is, obviously, me being from Panama and all and being born and raised there, this whole mining issue is now starting to pop up again. Remember back in December, we talked about, they wanted to renegotiate the copper mine, the Cobre Panama mine contract there. Well, they did renegotiate it. They did come to agree to a deal. They did pass that, and now basically there's been a huge uproar by the citizens there. And so it looks like the Panamanian government is looking to do a referendum on whether to basically go ahead with this mine or close this mine. And so it's not good. And so what you're seeing is that, First Quantum, which owns that mine, is down about 45 to 50% over the last week and a half. And so that's a big question.
Remind us again, what is this mine for?
It's a copper mine.
Copper mine.
Yeah, and it's about 300,000 tons a year. So it's one of the biggest mines over the last 10 years. And so I think the reason I mention that is because, a lot of these mines, copper prices have not been good. You're going to need copper prices to go up. You're going to need these governments to be basically cooperative. And I would say that Panamanian government's been very, very business friendly. This is a business unfriendly move. And so the reason I mention that is all these energy transition, materials, a lot of the stories we've had and we've heard is there's been setbacks. So this is not going to go as quickly as people think. It's not going to be going straight up. And so I just wanted to mention that because it's been a really tough time for those companies. Stocks are down a lot. Maybe there's some good values there, but I think there's a reset. And the last thing we'd say today is, which, is a little bit concerning is We saw a nuclear deal basically get nixed today. Ares Energy and X Energy, we're going to basically, form a public company, bring that company to market, and they're not. And one of the reasons, a couple of the reasons they said that they decided not to go ahead with this deal is because of, just markets in general and what's happening in the renewable space. And so I'd say that, everything, you got to be very careful in the energy transition space. It's going to go a lot slower than people think. And so, we still continue to think the oil and gas area is going to be a great area. The returns are there, and there's going to be a reset on some of these energy transition. I'm sure there's going to be some great values, but right now, a lot of crazy, spooky stuff is going on. So we'll turn it back to you.
All right. Crazy, spooky stuff, according to Mike. Arjun, what would you throw into our trick-or-treat basket here?
Yeah, Maynard, happy Halloween from me as well to everyone today. I thought I'd mix in some global and M&A themes given our guests that I'm really looking forward to speaking with. And, one of the issues we've been focused on is as and if shale matures, it's going to be a need for companies to start looking around the rest of the world again, something we haven't done since, 15, 20 years ago. And I think, Hess is a great example of you have impact exploration success, and you can do really well as a stock culminating in their sale last week to Chevron. I think when you look at Chevron, they got a little hit on earnings around some uncertainty around the timing of their Tengiz volumes, maybe a little bit of a cost overrun. Investors a little upset by that. And, people will say, see, going international, these mega projects, man, it's tough. Just stick with shale. But Maynard, last time I checked, shale wasn't without execution issues. There's been parent-child issues. There's been downspacing. There's been infrastructure challenges. All these energy projects at times can have execution issues. Look at offshore wind that Mike alluded to. This was supposed to be great. They didn't have commodity volatility, fixed price, PPAs, and a nice inflation. And suddenly you find your CapEx is way up, but that revenue component to it is not going to change, and you got to take write-off. So energy is a hard business. It is not easy, whether you're doing offshore wind, whether you're doing shale, or whether you're doing big international. It is one of the lessons. How do management teams execute? How do you get competitive advantage? And what are the other risks that we'll talk about today with our guest? I think a second big theme, Maynard, especially after Exxon and Chevron did deals, is, well, what about the European majors? And I think whether the European majors should engage in M&A or not, we should be reminded that they were all founded to find oil and gas and energy in the rest of the world to meet Europe's needs, with maybe the exception of Equinor, the former Statoil, a Norwegian-focused company. If you're Shell, you were trying to find oil in other parts of the world. If you're BP, it was Iran and Persia, as it was then called, so on and so forth. These companies are naturally global and exploration-oriented in nature. So it is unfortunate that over the last decade, they have faced a lot of pressure from their governments and policymakers and some component of their shareholder base to, quote, transition. And I think we've thought that we've not been huge fans of how aggressively some of the companies have been trying to transition. They're backing away from that. I think if you can ever get an easing of the pressure, if you can ever get some common sense and pragmatism towards meeting Europe and the world's energy needs, those European super majors, we need them. It can't just be US and Canadian oils to help counterbalance the Middle East and Russia. The world is a better place with a healthier European supermajor mix. And I can't predict what's going to change or not change in their policy, but those companies are especially well suited. They were not, for the most part, big shale players. They're especially well suited to go into the rest of the world. Many of them have continued exploration programs, and I do hope they will be able to find their way going forward. We're going to need the European supermajors. I think the last point, Maynard, would really be, if you're not a super major and you're a domestic company, let's just focus on US companies. How do you go international? You've generally not had to try to do it since the 90s. And if I remember back to that era, it was a challenge. If you were Exxon or Mobil or Chevron or whomever large company, you had a platform, you had the balance sheet, you had the scale, you had the skill set to do international. The kind of random one-off projects from E&Ps, yeah, there were some okay ones there, but I think investors always struggle with, is this the appropriate risk for domestic companies to be taken? How do you develop scale in a newer area? And I think these are maybe some of the questions I think we'll be able to turn to with our guest today. If you're not a big, sizable company, how do you do international well? And probably most importantly, how do you avoid doing it poorly? And Maynard, with that, I'm gonna turn it over to you.
Wow, fantastic, guys. So Alexis, you see, meet the family. This is what we do. We just kind of get excited and start talking about all these issues and all these questions. Maybe one place to start, because I could jump in on interest rates. I could jump in on scale as you do things globally. Those were two great themes, listening to Mike and Arjun. But maybe one just basic place to start is tell us a little bit about the group. And I know you started at PwC in 2015, so this is not new. But tell us about the resources, how you integrate into PwC, and kind of what led PwC to say, we need this part of our company to help our clients think through all these issues.
Sure. No, thanks so much, Maynard. So, yes, we actually, it's funny, there's a sort of flurry of headlines about various investment banks and entities setting up a geopolitical practice, and we're getting a lot of hunger from financial services clients across the world and need for counsel on how to set up their practices. Yes, joined PwC 2015 with the mandate of establishing our geopolitical practice. And at that time, I did a sort of competitive benchmarking exercise and looked across. And what PwC needed was for somebody to come in and say, can you do an analysis of the global geopolitical landscape, but then bring it back down to what it means for our clients, really helping them guide and inform their own investing decisions. Mm-hmm. And there are a lot of geopolitical shops out there that have really, really rich analysis, but a lot of it kind of fails to translate into real day business decisions. And so that's what I joined the firm to do. And then immediately amidst all of this, I said, wait a second, there's a huge component missing from a lot of these geopolitical shops, which is global macroeconomics, because it's markets first, right? And so effectively what I do is work as our global chief economist, but client facing. Mm-hmm. And that's, really market oriented. And that's, I think, also distinguishes us from some of the other banks where a chief economist or a chief investing strategist is focused on the bank's portfolio rather than on the clients, generally speaking. Mm. The other thing is, back at that time, just looking at the movements with the RMB, I said, we have to be focused on currencies across the globe, obviously commodity prices, having come from a background in energy investing. So I've really enjoyed the time, and then I spend my time, I would say, half globally, half in the US, and then half with corporates in energy, media, technology, telecom, consumer, and then half in private markets and real estate, infrastructure, private equity.
Wow. That is so interesting. We'd like to just travel around with you and be part of those conversations. I bet it's fascinating.
Thank you. Well, we can do a little bit of a magic carpet ride today.
Okay, let's do it. So I guess I was struck when you said 2015, and you think about what the world looked like in 2015 to today, 2023. And two of the things that stick out, these interest rates we have now, that would be one. The second one that sticks out is in 2015, China was our friend. China was the next great thing. There was a lot of momentum around that relationship and what China was going to do. And in general, there was a lot of momentum around global markets, trade, globalization. So now we're in this world where we have interest rates much higher than we've seen in such a long time. We have the world unraveling its commitment to global trade. And then, of course, we have inflation. So, wow, what a much more complicated world. What strikes you when you're in boardrooms as like the number one question that keeps coming up regardless of industry? Or is there a pattern or something that you see, kind of across all those clients?
Thank you, Maynard. So I think firstly, just with regard to interest rates and inflation, the monetary policy response, that is a front-running question. And we were addicted to a decade plus of free money. And so I think, first and foremost for many CFOs particularly is, what is the cost of capital today? And our answer to them is, it's not exactly free, but it's not exactly expensive in the way that it had been, going back to the 70s and 80s. So with regard to the direction of rates, and I would say that, those having been a response, tightening having been a response to higher inflation, I think we need to look at some of the underlying sources of inflation. And I'm a long proponent that we've been in a largely supply side driven inflationary environment coming out of the COVID-19 pandemic. As we know, headline and core inflation are closely correlated with the price of WTI. WTI very closely correlated since 2014 with the other metals and foods part of the basket in commodity prices. So we look back, we entered into COVID in a price war within OPEC. We had that phenomenon of negative oil. Oil production fell by the single greatest amount in post-war history. And then demand continues to surprise to the upside. Nobody thought that people would be flying around. Everyone forecasted that the car and the automobile was dead. And so then all of a sudden, everybody wanted to be in an automobile coming out of COVID and the pandemic. Even domestic air passenger traffic in regions like Russia, mainland China, Brazil, significantly supporting the use of oil for jet fuel. Manufacturing activities supported by fiscal policy in governments like Brazil and China, also heavily reliant on oil as an input. Then if you think about the kind of the supply side constraints that we faced with regard to supply chain bottlenecks, one meaningful data point that we noted was a lot of these bottlenecks got resolved by significant investment in smart logistics. So the same amount of ships were coming into the port of Los Angeles, but they were actually going through, whereas they had been congested throughout the early part of the pandemic economy years. Then when we start to see pricing come down, I think investors and executives kind of braced for a moderation. Russia invades Ukraine. And that, of course, resulted in an entire rewriting of the global energy map, and this relatively elevated commodity price landscape that we've been living in. In economies such as Germany, which are much more deeply exposed to the energy crisis, you do continue to see, I would say, higher energy costs eating into the household balance sheet and eating into corporate balance sheets. It's actually causing some structural problems, moving some activity offshore in Germany, where manufacturers just say we can't stomach the cost anymore. How have central bankers responded to this? I always said that if I had a dime for every time I heard the words "this Fed" throughout the crisis, or every time I heard the words, the B of E, that central bankers were largely maligned for their mismanagement of price stability. One thing to note with the Fed is that it is entirely staffed by macroeconomists, and you really did need microeconomists to understand some of these shocks to supply and demand that we experienced, particularly in these sort of other strange sectors like rental car and airfares. I would say that credibility has been on the line, particularly for the Fed and the ECB as a result, and that they're likely to hold higher for longer. So coming back to the original scene setting and thinking about the Halloween FOMC meeting today and tomorrow, our forecast is also that you would hold steady. What's interesting to note and tie that back to bond finance and bond markets is that for the first time since the GFC, the yield on the US 10-year briefly hit 5%. And so what we're also seeing is the potential return of bond vigilantism. So you have, again, issues of supply and demand here, where the Fed is no longer buying up US Treasuries. You have Treasury putting out to auction a lot of long-dated notes, which will immediately put upward pressure on yields. And investors are demanding to be paid more to hold these treasuries. Added to that, you had a significant credit downgrade for the United States. Some said that was unwarranted, but when you look at the amount of discord that's on the Hill, the imminent rolling government shutdowns, kicking the can down the line, this is significant. So we're in a higher for longer environment, but our forecast is, and for all the energy executives that are listening today, our forecast is that doesn't mean double-digit rates. That doesn't mean double-digit inflation. There are too many secular and structural forces sagging and weighing on the US economy and other advanced economies that we forecast will push rates back down over the longer term. Our forecast is 3.5% at the longer run at the start of 2027, which again is not expensive, but it's not free. And some of those forces are aging demographics. If you think about the salary of a new entrant to the labor market, it has not been met by the retiring baby boomer salary. There's a huge spread between those two numbers. Lackluster immigration policy, particularly in the United States, where this is concerning. Just those structural shifts in moving from manufacturing goods producing economies to services oriented economies means you're going to have a huge bifurcation in the labor market. You have a savings glut of the rich. Our forecast is that these forces far outweigh some of the medium-term phenomenon, such as the Great Green Scramble and the rush into the energy transition. We do not see that as being disorderly because governments are cash-strapped. We just talked about the EV market cooling a little bit. When that's not supported by government subsidies, we've actually seen that in the Chinese data where Chinese purchases start to slow. Another argument is that the return of the military-industrial complex and defense spending will actually push rates up over the longer term, but we don't necessarily see this as being sticky and a longer-term phenomenon spread across markets beyond the United States. On the China question, it is interesting, and Maynard, in response to your question, I was thinking, the seeds for America's national insecurity complex were already being sowed in 2015, and they had been sowed arguably since the 1970s, when we had this moment of a great kind of growth miracle and productivity miracle in the U.S. From 1870 to 1970, and really productivity starts to slope off after then. When the United States starts to be faced with import competition from China, we did not respond in kind with higher productivity. We went into other sectors that were where we excelled, like information technology and services, telecom, financial services, particularly focus on the finance and really the real economy serving finance rather than the other way around. And that was where we focused, whereas China excelled in producing furniture, toys, textiles, electronic manufacturing. And so I would say that the United States gets slightly insecure with this situation. Added to that, some of the disputes you saw going back to the legal disputes within the WTO on rare earth minerals, going back to the Obama administration. So you come into this moment of the Trump presidency with a severe amount of distrust and a deficit of distrust, a deficit of trust between the two economies. And I think that's how we entered in. And our forecast was that with a Biden administration, you'd see a change in tone, but not posture with regard to mainland China. And that certainly played out. The green phenomenon is one place where you have seen some collaboration, but guess what? When the United States slaps tariffs on Chinese solar panels, the cost of solar goes up dramatically in the United States. There is a question as to whether or not you can go green without going Chinese products and inputs. When we think about this claims of deglobalization, something we're writing on at the moment, you certainly see a technological decoupling between the United States and China, but that doesn't equivocate to deglobalization. We see fragmentation on a global stage, fragmentation of supply chains, but actually in some arenas like finance and reserve currencies, there's markedly no fragmentation. The dollar is still the reserve currency. And so I would say that we're in an increasingly complex world with this fragmentation, but not necessarily wholesale localized or deglobalized.
There's so much to wade into here. I guess one thing I want to test with you or see if this comes up in the boardroom and just see how you think about this is, one observation I feel like we've had here is once you get volatility, the probability that you get greater volatility seems to be the case. So once you have Ukraine, you might get an Israel situation. Once you get stress in the system, you might have an auto strike. Once things are tight, the probability that something else happens that is kind of aimed at that tightness in some way, shape, or form, is that a judgment you share? And if it is, how do you talk to boards about, okay, things look volatile, and you need to think about all the other volatile things that might happen, even if your longer term hope slash forecast is, hey, things will calm down, it'll get better. Like how do you manage? I think volatility is my question for you, Alexis.
Well, it's interesting, right? That like the market person in me says, how measured the VIX? Where does the VIX stand? And something that jumps out at me too is we have this phenomenon, particularly in US equity markets, where equity markets move out of sync with economic reality. And we had that very much at the start of COVID, where you saw, I'm being in New York City, you saw an extraordinary amount of spike in homelessness, the health crisis here and the economic crisis combined, and yet equity markets continued to hit historic highs. And so something here I think is important because it plays into investors' mindset where VIX might be low, but there might be other volatile things happening on the global horizon. One thing that I always think is important is to be prudential in the outlook, see where there are pockets of financial instability because we will always have them, therefore play out the scenarios of what could happen. But do that in order to be able to take advantage of any kind of dislocation in a market. So an example of that would have been for us when Trump came into office. That was a significant opportunity in Chinese new economy. If you were going into liquid markets and you were going in with a medium-term horizon, and we saw a lot of clients make a significant profit with regard to that. So be prepared for the dislocation. I would say that going forward, I would say we focus more on themes. One theme that most investors are not comfortable with is polarization within domestic societies, which is inevitable. As I mentioned, some of the seeds for America's national insecurity complex were sown back in the 1970s. For any advanced economy that is moving out of manufacturing, bigger pie-oriented growth and into services-oriented growth, the pie is going to be smaller. You're going to have the haves and the white-collar jobs and the have-nots and the blue-collar jobs, significant wealth and inequality of opportunity in between. What are some of the structural forces that can combat that polarization? That's one thing. Again, many investors and executives, policymakers even don't want to think about that. The other thing is what could be the scenarios playing out with increasing polarization. One of those is the rise of the right, rise in protectionist movements that we've seen. This is something the ECB has actually focused on and is calling out. So I would say we focus more on themes, and then that means that if you are focused on themes, you're prepared for the worst, or hopefully, we're seeing the worst play out in the Middle East, but you're prepared for some of the worst, and therefore you can be with dry powder ready to take advantage of an opportunity.
So I'll take your some of your comments to mean remember volatility can be your friend. Watch for it, and you can take advantage of it too. On energy, I was struck by you said 1870 to 1970. U.S. productivity was increasing, and I kind of jumped to in the 70s I associate with energy shock and lower productivity. And then I was thinking your comments about a service economy and a manufacturing economy. What is, of course, so important to manufacturers is energy costs. And so when you think about energy costs and the role they're playing in inflation and therefore some of those other issues that are connected to them, how do you think about those and how central are energy costs as an input to your whether it's which countries are going to grow, is the global economy going to grow, energy's in every good at some level, so inflation. Like, how do you think about energy as a core component of some of those things that you're touching on?
That's an excellent question. Thank you. Immediately when I was sitting in Morocco digesting the Israeli conflict, I wrote to my team and I said, can you please pull up a chart of WTI and global GDP? Because of course, when you look at global, WTI, global GDP, immediately once you hit north an energy shock, immediately the globe falls into recession. Because if you think about it, we are so reliant on oil to move people around the globe, to fuel transport, to fuel manufacturing activity, power generation, increasingly with gas to oil switching, and just again, that tight correlation of WTI with other commodity prices historically. So that's the first thing I think is, as you say, and even going back, we always fight the last crisis, and going back to the last crisis, with just looking at WTI right before the GFC, completely unsustainable and unaffordable. It's interesting you mentioned so that's where I would say about looking at the correlation with activity. And I think many traders and market participants are braced about whether or not this Israeli conflict will expand into a wider conflict. The other thing you mentioned was just productivity, which is slightly different. And one thing I think that's interesting to note is that we really have reached a turning point where central banks across the globe are very direct in their assessment of the relationship between climate change and productivity. And so the Central Bank of Brazil putting out a report prior to COVID actually saying, exploring the whole relationship of sustainability to productivity, and basically saying that with climate change, we will have lower productivity over the longer term. So how, therefore, can we mitigate climate change? When we experience the extreme heat that we experienced this summer, the NIH came out with a report about what the significant output gaps that would actually happen, the loss of productivity. They calculate that was 10% over the summer, and that could expand to by 30 to 40% if in the most extreme scenario by 2040. So this is, I think, something that's playing into policymakers' minds. Certainly what we've seen with regard to the immediate conflict in Russia-Ukraine was you see skyrocketing nat gas prices, an energy crisis, and then the Eurozone's largest economy, Germany, tipping into recession, technical recession, then Europe tipping into technical recession. So we clearly see the relationship of low-cost energy and access to sustainable supplies as being implicitly related to the productivity of companies going forward. And that's something I think people are not taking for granted. Just coming back to some of Arjun's comments, the fact that you see one Dutch company cementing a 30-year contract in nat gas with Qatar is meaningful. The fact that you see one French company cementing a 30-year nat gas contract with Qatar is meaningful. By the way, if those deliveries go on throughout the lifetime of that contract, they will be delivered beyond 2050, which is the year mark of many net zero or decarbonization goals. So that being said, I think countries, in particular Europe, are waking up to this fact and this reality. I would say that if you look at OPEC's latest forecast, they forecast that you will have the growth of renewables expanding demand for renewables expanding by 200% by 2045, and about oil increasing by demand by increasing by about 16 to 17% by 2045. I don't think it's impossible to have these two growth scenarios in one hand. Said another way, you can have 200% growth of renewables, but you will still have oil demand growing. And so I think when I think about the relationship of energy to productivity, economic output, we're in a changing scenario, again, where climate change is negatively impacting economic growth, particularly in some geographies, coastal GDP. But we will continue to rely on oil and natural gas to fuel economic growth going forward. We have to get much more creative about methane capture, CCUS, et cetera, which is, in our forecast, those are promising industries.
Yeah, Alexis, I'm glad you're here with us today. It's been pretty interesting. One of the questions I have is presidential election coming up, right? I mean, how are your clients thinking about that, how things might go with a Trump presidency or Biden, or whatever the case may be, just from a geopolitical standpoint, with maybe reversing some issues, domestically with alternative energy, immigration, stuff of that nature. Where do you see them right now? Are they worried? Are they optimistic? I mean, and what are they going to potentially do in one scenario or the other?
Thanks so much. It's a great question. So I was actually just speaking about this morning with asset wealth management industry. And it's fascinating because what we've been saying is, okay, we're seeing a lot of global investors say we're actually going to double down on allocating to the United States. And so I put the challenge to them. I say, is this because you're convinced of the economic dynamism of the United States, or is this because the rest of the world looks so bad that this is, there is no alternative? And it's funny because they'll have different responses. The same thing goes for China, by the way, because you could say to somebody, are you starting to divest from China because you think the economy is in a poor state, or because of other reasons? And so with regard to the US, I immigrated from the UK to the US 11 years ago to set up a business because I believed in some of the key tenets in the American economy, for all its woes and for all of its rancor, are still present. And that is, the innovation that happens in this country, which, as you highlighted, is supported by significant immigration policy. So the direction of net international migration going south over the last few years has been meaningful. We're starting to see some uptick, but I think many are going to be focused on immigration policy. What happens in the next administration with that, of course, is very much in charge with regard to what the White House can do and what the White House can do actually with the support of Congress. And so I've also said, whoever's in the White House, you need to focus on what's happening in Congress and whether anything can get done. Just looking at the intransigence on the debt ceiling and just kicking the can down the line on this is meaningful. On the IRA, I have an excellent colleague or partner in Washington who'd be better placed to talk to you about the fate of the IRA, and maybe that's a future episode. He's comes from the Republican side, and he's very clearly stated that he's like, we don't see any meaningful clawback of some of these provisions should you actually see a Republican presidency. In fact, if you look at some of the red states that have been huge beneficiaries of this, nobody's going to be keen to reverse any of these investments. Something we've also counseled with regard to that is the United States is highly decentralized, right? And so if you're wanting to be a clean tech investor and benefiting from any of these provisions, go to the cities and states where there have been the most generous support of this, right? So California comes to mind as one example. Texas is another example, which is the country's largest wind energy producer. And so that's been our counsel. But I would say that the long and short of it is, if the world looks so bad, we are continuing to see people tack back to the US.
Hey, Alexis, I might jump in with maybe a follow-up to some of the question that I raised in my opening remarks is, we're energy focused as a firm, but if you'd like to speak more broadly, that's fine. It is sort of the framework for how you advise or how your firm advises companies to think about international expansion. So for us, it's energy suppliers. And I might say for the smaller ones, and maybe I'll define it as sub $25 billion market cap. You can use a different definition, but not the largest companies, but maybe not the tiniest either. What is a good framework for how to kind of get this more right, the pitfalls to avoid, what are the prerequisites, skill sets needed? How do you think about advising companies that might be domestic and focused to, hey, here's how to think about and get right going international?
Arjun, it's an excellent question. Thank you for bringing it up. I saw that in the energy space, particularly with some of the mini majors, where when you saw endless streams of capital, and I remember kind of getting on a plane coming from New York to Midland, seeing some of these like New York driver's licenses being thrown in the TSA tray. I'm like, I've never seen that before, So this endless stream of capital coming from New York to go into real assets. And for the first time, many of these investors became energy investors because guess what? We can get the income, we can get a steady IRR, we can get a nice, capital appreciation without the geopolitical risk that we've associated with energy going forward. Talk to, and I won't name names, but talk to one of the European major CEOs, as you say, historically, they know the dance in the Middle East. They've been doing it for 80 years, 100 years. It's all about relationships there. It's about, hugely, deeply enshrined collaboration with local actors. And that's something that American companies haven't necessarily always gotten right, particularly in the small. There are some exceptions within the mini majors. So I think that phenomenon was in place. And then, of course, you still need economics to work. And if you look at a break-even cost, although there have been some kind of bullish estimates on shale, if you look at saying a conservative break-even cost is $80 a barrel, some of those plays are not sustainable no matter what kind of technology you have. So as you say, the sunset on shale may make you look to other jurisdictions. The ones that I think get it right are the ones who say, where's the lowest cost production available? And it might be in some unsexy jurisdictions like Canada, not Athabasca, but some of the light tight oil and liquids-rich gas plays. Whereas that's not the Permian, but it still looks attractive from an economic standpoint and from an end market standpoint. The UAE, Saudi Arabia, Oman, although the rock is harder to get to in Oman. Even companies that have been benefiting from Iraq and Iraqi oil production, reducing some of the bottlenecks there. So I would say in the GCC, you're looking at, so from an economic standpoint, where's the lowest cost? In the GCC, it's entirely all about relationships and patience. I think some of the US mini majors forgot that, and we'll need to resurrect that. And we'll need to think strategically about the types of people they're hiring in country and at the executive and board level to be able to support that as well. Another dynamic here is the US has retrenched from the Middle East, I think, for two main reasons. One was the Permian Basin. The second was the Abraham Accords. Now, all of that's kind of ripped up on the second point. But it was to Asia's gain. And so we've seen significant capital ties and cross-border investment between South Korea, Saudi Arabia, China, India, and this has been to US and Europe's loss. So by the way, wake up, because you need to be at the table and present to be able to take advantage of some of these deals. And that's not just in energy, that goes across sectors. And so I think there's no time to lose here.
You made some really great points there where low cost resource always win. I don't think there's going to be an energy executive who would disagree with that. The point of relationships is really well articulated and a good reminder of maybe some of the challenges of especially going to some of the countries you mentioned, the Middle East. And I know Maynard may want to follow up with you. I think you mentioned in the pregame that you just came back from there. But one final question, if you don't mind me asking, which is the area I've always found intriguing, but the challenges are obvious, is Latin America, where there is sizable low-cost resource in Venezuela, really fun place. Brazil, more deep water, it takes a little bit of a different skill set. Argentina, but the issue with the oil in these places is that they're in Venezuela and Argentina and Brazil and all the pros and cons that come with that. Any comments on Latin America specifically? And is it partner, if you're a smaller company and don't have the relationships, does that mean then partnering with some independent or even state company there? And what do you think maybe specifically about those three large oil producing areas that need to grow supply? The world needs their supply, but they've got their geopolitical challenges, as we know.
Really, really tough. And thanks for asking, because, we often think it's kind of our backyard, for better or worse, in the United States. Very, very tough. I can see Dan Yergin's book on Maynard's shelf, and you go back to his exceptional history, the prize, and, Mexico wrote the textbook on nationalization of oil, right? And so going back to the 1930s. And so for me, the worrisome trend here is that natural resources are considered to be the Bolsa Familia, to take the Brazilian phrase. And so really it is the sovereign lifeblood of the country, which supports generous civil schemes. So the tendency to nationalize assets to support generous spending, I think, is real and significant. And it's something we've seen for the last 100 years in the continent. When speaking with energy investors about Brazil, I would always say, or investors about Brazil, full stop, I would say, I think most sectors are on in Brazil. I wouldn't touch energy in this regard, just simply because the risk of nationalization is so high. One exception, smaller market, one exception has been Colombia, where prior to PwC, working with some investors who saw significant enterprise value appreciation and steady IRR with some nat gas and oil assets in Colombia. Of course, now I would make a play on the new president's name, the not so Petro administration, I think, has made this a concern with regard to focus on decarbonization. But that would be a market that I would actually look at in the future. But for me, it would be off limits just in terms of energy in the continent. Added to that, I would say you've had a significant sweep left, which might have an impact on fiscal balances. We're seeing that play out in Brazil in real time.
One question, and Arjun referenced it, and you mentioned it in the upfront, Alexis, which is the Mideast. You're just back from spending a couple weeks there. You gave all that great commentary around kind of what's happened to U.S. engagement in the Mideast. I think the thing Mike talked about it and has been talking about it is why isn't this problem going to get worse? And what's kind of a snapshot of the region for those of us just reading about it? What are we missing, or what would you share that is probably just different from what we're all thinking? Because we all seem to be lulling ourselves into we're going to have an unfortunate, terrible situation between Israel and Hamas, but somehow that's going to go away.
Not an easy one. I mean, I would say to start with what was the bright side for many was the Abraham Accords, right? The normalization of ties with the UAE and looking to Saudi to normalize. And that was, I think, very meaningful for the region. I'm going to situate the current conflict within this wider context of fragmentation that I mentioned, where when you look at the map of the UN General Assembly vote upon Russia's invasion of Ukraine, we see a heavily fragmented world. When Jake Sullivan calls the UAE and Saudi to turn on the taps and increase supply so that prices will come down, you don't necessarily see Abu Dhabi and Riyadh responding in kind. And so we have a situation where the Middle East is not America's lapdog. You have, the direct intervention from countries such as China. You have strengthening trade ties between China and Saudi Arabia. So, the US again has withdrawn somewhat from the region. So we're not in a kind of US dominated world or unipolar world. And so it's a dangerous place. Where America stands with regard to Iran, I think is really significant. And so I think many are braced for, again, whether or not this conflict somewhat escalates throughout, and creates congestion in the Persian Gulf and even further out in the Mediterranean. So I unfortunately, I don't have any easy answers here.
It's funny when you replay the last, I guess, 23 years of the Mideast, you do 8 years of Bush Cheney, right? And you have a certain kind of, obviously, a policy. Then you have 8 years of Obama, which had a second approach. Then you do a 4-year Trump intervention. And now you've had, coming up on 3 years of Biden. So if you are the Mideast, any of those players, you must just be watching the U.S. saying, wow, you guys, you're this way, then you're that way, then you're this way, then you're that way. So the U.S. just looks like a place which is really hard to do business with, for lack of a better way to say it, because just the toggling of approach is pretty intense over what is a short period of time in geopolitics.
Well, and even I would say the Middle East is not alone. Like, who's a reliable partner? Looking back to Europe during the Trump years, Singapore, I often hear this from prominent Singaporean policymakers, is, okay, you want us to be pro-US, but you kind of left us out in the cold, and our GDP growth tanked because it's reliant on trade. So how are we meant to look at China if you leave us out in the cold? And so I think, again, many countries, are thinking this way, not just in the Middle East.
One question that comes up around here, Alexis, that I'd be very curious to get your views is, you mentioned the sort of dysfunction around the U.S. borrowing, the U.S. budget. Just, it's not a pretty picture. It's also just not a pretty picture just in terms of total debt, the deficit amount, like what we're supposedly going to spend Like, how do you think about all of that and how it relates to the dollar? You know, it touches so many things. And then there's always some constituency that says, stop worrying about it because it's not as bad as, or how do you think about the debt?
It's an excellent question. I am a huge budget hawk and deficit hawk. I'm a big believer that sustainable economic growth and a balanced budget go hand in hand. We mentioned that moment of when the yield on the US 10-year in October hit 5%. It was fascinating because when the yields on the long-dated bonds increased significantly during the Clinton administration, that actually forced the Clinton administration into more budget restraint and responsibility and fiscal responsibility. So then finally, you actually see the government moving into surplus. It'll be interesting to see how this plays out. What I think is interesting when you speak to Rubin or other policymakers who were present at that time, what's fascinating right now is looking beyond who's in the White House. Both sides of Congress seem to not really care anymore. And that's unique. You don't really have many budget hawks on either side because, as you say, there's kind of this undercurrent of, well, the dollar is the world's reserve currency. US 10 years a safe haven of choice. And so investors will keep crowding in and there'll be no shortage of demand. I think America's an adolescent country and we've got about 30 years to play that adolescence out. During which time I don't really see many challenges to the US dollar as the world's reserve currency. I think it has significant impact when you do have an investment downgrade. You lose your AAA rating in part because of mismanagement and the dysfunction that you highlight. But again, the world's such a dark place that people keep coming back into the 10-year and back into the dollar, which again pushes value up over the longer term. So I think we've got about 30 years. There's an interesting kind of, in the monetary policy debate, there's this other kind of debate as to whether or not racking up debt will be at the cost of future generations who can't necessarily support that debt. There's various schools of thoughts on this, modern monetary theory, one of them being, that it doesn't necessarily matter. I would highly disagree. To just put a bright spot, one country that I think is interesting here is Singapore, where they look at government debt. They basically raise debt to then invest on balance sheet into infrastructure that will generate ROI. So you're actually using productive debt on a public basis to be able to create growth. And maybe that's something we should be thinking about rather than just outlays. Where are we actually making creative investments going forward?
Well, we've covered so many things. I knew we all knew this would be fantastic. Are there variables we didn't hit on, right? So we kind of moved around the globe. We hit as many as we could, but as you find yourself talking to boards or just thinking about the issues, is there anything that we should be thinking about that we haven't hit on?
One thing that I'm excited about when I think about energy companies is talent. And what are the skills of the future that are needed to be able to support economic growth? And I'm going to actually tie that to, what if the United States was making creative investments significantly? And I would be thinking about, you already have all of the rich engineering base and skills population within some of these companies to be able to navigate the transition. So I would be thinking about that if I was an executive from a reporting standpoint, because increasingly I think you might be focusing on the S rather than just the ESG with regard to reporting and human capital. I'd also probably be thinking about that from an investing standpoint. How are you doing postdoc or degree certificates to be able to support energy production, transmission, and storage going forward? I'd be thinking about it from a venture capital standpoint too. So that's just one aspect that is promising to me.
Yeah, I think one of the things we didn't talk about, Alexis, is maybe AI. And maybe, I look at sort of 2000 to 2020 is just the growth of the internet and just, computing and power and the cloud and all that. But the next 20 to 30 years is going to be about AI. What do you think? How are companies thinking about that right now? What are the geopolitical considerations of that as well?
No, it's an excellent question. First of all, from the macroeconomic standpoint, I'm a big believer that we've had successive industrial revolutions And so therefore we've seen certain skills get automated out with increased capital investment into industry. When Mr. Ford came along with his Model T, the horse-drawn carriage went out of business somewhat. And so therefore did the people that tended to the horses. But guess what? You had auto mechanics. And my great-grandfather, grandfather, father, all in the automotive industry. And my father always says the service shop is the single greatest profit-making mechanism in the dealership. So guess what? Even with all the technology that we've had, the service shop is still the single greatest, most profitable part of the dealership. So I think to set that in the context is I'm not as worried about the replacement of certain skills as some others, doomsday scenarios. It does mean, again, tying that back to the talent question, it does mean that we're going to have to be investing in the skills that can't be automated. My accountant will have and has had parts of her job automated. So she's going to have to get more creative about wealth management. So we're going to need to be continual students in upskilling. As you mentioned on the geopolitical standards, this is interesting, right? Where I think set against the backdrop of the technological decoupling between the US and China, we are seeing different standards emerge. And you're seeing some global boards and executives talk about this is like, how are we handling differing standards on a geographical basis? The other thing is this relationship of the human being the subject of work rather than the object of work. And how are we going to constantly maintain this position of being the subject rather than the object? Because if you're a machine, you're making it the object. And I think that that's an ethical consideration to play out. Actually, in work with the World Economic Forum, we are seeing some interesting work come out of the Vatican on AI, and this being shared across the globe with regard to ethical considerations. Also, lastly, on the energy front, it's interesting to note just how energy intensive the data centers to support Gen AI are. And I think a lot of investors and executives haven't really seen that yet.
Maybe just as a final question for me, Alexis, you alluded to the idea that those LNG contracts for 27 years, not sure who exactly came up with those, that specific of a year number, but they certainly extend beyond 2050. I think there's a pragmatism that we're going to need all forms of energy for the foreseeable future. And there isn't a silver bullet to get us to quote net zero by 2050. Yet the goals persist. There's probably a point to them persisting. So you keep pressure on companies to at least try to do something differently. But if my final question is on Europe, do you sense a pragmatism going there? And again, Maynard always reminds us that anytime we see signs of pragmatism, we get super excited because that's sort of, our core ethos to be realistic about these things. Is there a sense that Europe kind of understands, yes, solar and wind can be part of the mix. Yes, we got to do some other things. But at the end of the day, we're going to need all of everything, including in Europe, never mind, the billions of people in the rest of the world. Even in Europe, we're going to need some of the traditional stuff. Are we falsely hopeful of pragmatism there? Or what are your takes?
Arjun, you say pragmatism, I say humility. Because there was not a lot of humility when we started to see the seeds of this energy crisis set. September 2021, I was in the UK when wind power shut off. And then guess what? Nat gas futures spiked to $200 a barrel oil equivalent. So I've not seen a lot of humility. Part of the reason for that, I think, is that Europe does remain the mecca of green energy. And it is very much, I would say, within the culture of the institutions, the central banks and the banks to pursue some of these decarbonization Paris goals. What's interesting to see is, okay, I have to look at the stick and the carrot as an economist, and I would say, what happens from a reporting standpoint? What will regulators actually require? We're seeing that with the SEC here in the United States. So on the stick side of things, and then on the carrot side of things, how creative will the Europeans get on incentivizing? How much capital will be there to be able to create incentives is another one, because we have record levels of public debt across the globe. We're seeing some hydrogen producers say we need to see more of a European market supported by the government to make hydrogen economic. So those are some of the things, the factors that I would be looking at. But I continue to see the demand outlook being consistently undershot, and I think that's probably to a disadvantage when you think about forecasting for Europe.
Thank you so much, Dr. Crow. This has been so interesting. We've covered so much territory. We knew we would. You started by saying early on you're a markets person, and one of the things we're always trying to think about is, okay, over the next 10 years, what are the key trends? That feels like that's the boardroom, time frame that everybody usually thinks in. As a last question, it seems like, for whatever reason, in many parts of the world, including in the US, we've gotten more comfortable with government intervention, government support, government. It feels like we've gotten a little bit away from free markets as a core philosophy, or we've drifted a little. Do you think that's right? And do you think that changes over the next 10 years? Because these things tend to go in big cycles.
That's quite a question. So I would say that it's interesting when you think about state support and what that looks like. The IMF, in a recent report coming out of the Marrakesh IMF meetings, which is why I was in Morocco, wrote a report and saying to counseling Middle Eastern, North African governments that they really needed to take a step back from the economy. But it's fascinating because when you look at some of the biggest players in the energy transition, which is what the IMF is supporting and the World Bank by association, a lot of the state-owned companies are the ones who are pushing the transition and actually deploying capital to the transition. So there's a kind of a trade-off of what do you want to pursue and what are the most effective entities at doing that? I'd say, Maynard, I still see the DNA of the United States as being pretty laissez-faire. Yes, we've had a lot of state support in the IRA, but I still see the US as being pretty laissez-faire and decentralized. I don't think that's so much. And you could look about that, the sort of hodgepodge of restrictions during the pandemic, which was in direct contrast to Canada or Europe. So I still see there being pretty strong libertarian roots. The question I would say is, if I was an economic policymaker, are there things that the United States could be doing from a public investment level, a more creative way of using taxpayers' money to reduce some of the rampant inequalities that we face today? We have a crisis in affordability of housing that's not going to go away anytime soon. Could there be greater incentives? Yes, absolutely, to be able to address the affordability crisis. So that's what I would be thinking is, how do you support the productivity of a workforce? Could there be more efficient investments in healthcare in the United States? Probably, or even preventive medicine, integrative health, probably. So that's, I think, what I would be looking at is, there could be some sectors that should be ripe for public investment, and then some, obviously, where the state needs to take a step back.
Well, maybe, as you said, kind of like the Clinton administration comment about if we get more pressure from interest rates, it forces people to think about more creative solutions on how we're going to deal with some of these issues. So, well, Dr. Crow, thank you so much. We were so delighted to meet you and count you as a friend. And I hope you'll come visit us in Houston and let us know how we can help you if we ever can.
Awesome. Thank you so much. No, it's such a pleasure.
No, we loved it. Thanks, everybody.